Hello and welcome back to The Note. Let's take a look at China today. This month has seen the managed default of Chaori Solar, an event that many people are referring to as China's Bear Stearns moment. An alarming concept because, of course, Bear Stearns came a matter of months before the Lehman moment in the US. How serious is the situation in China? Is there a way they can manage this to avoid their own Lehman moment? With me now to discuss this is the head of macroeconomic research at Lombard Street Research here in the UK, Diana Choyleva. Diana, thank you very much for joining me again today. Let's start by taking a look at the overall picture of Chinese non-financial debt, which shows that since the crisis, debt really has gone through the roof. What's happening here?
Absolutely. China is in an extremely precarious situation because the authorities can no longer just throw money at unproductive investment without debt building up fast. And the key change was the global financial crisis.
Yes.
What happened afterwards was that first China's export markets were no longer growing at the same high rates as before. So it was a large export shock. But worse still, the yuan actually adjusted over the last 5 years and on our estimates is now overvalued. So they can no longer grab even larger shares of this not growing global trade pie. Okay,
so the long-standing US complaint that China has been protectionist through its currency no longer stands, even if it plainly did for a while. Now, you've got a very alarming comparison here, which is comparing the way Chinese non-financial debt has been increasing compared to Japan during its great run-up that obviously ended in a stall. Is this a valid comparison? I mean, it suggests that China is heading for something that much worse than what happened to Japan after 1990.
There are a lot of similarities between China and Japan in terms of their economic and financial structure. So I tend to find that looking at Japan's catch-up growth period and then moving on to the halving of its miracle growth through the 70s and 80s and then the bursting of the bubble is quite instructive for trying to figure out what happens with China. And the worry here is that the rate of increase in private debt in China has been faster than what happened to Japan in the late 80s.
And we see a second pickup. It's not just that first pickup there for the initial crisis. There was a second pickup ahead of the change in leadership a year or so ago.
Yes, and what a lot of studies have found is that actually the rate of increase of debt ahead of a crisis is as important, if not more important, than the absolute level of debt in the economy. So from that perspective, this is a particularly worrying development.
Okay, now let's try to calm things down a little. If we take a look at this in context of whether China has the money to deal with this. As I understand it from here, China, yes, does have the money to deal with it. How exactly do you think it should deal with this problem over the next few months?
Well, you mentioned at your introduction that we don't want a Lehman's moment, but actually I would argue that we do want a Lehman moment. We do want the Chinese authorities to let failures fail. The sooner they do that, the more capable they will be of cleaning up the system, allowing market forces to distribute their huge savings in search of high return, taking risk into account. Yes, it's going to be highly disruptive over the next 2-3 years, both in terms of very weak growth, but also financial distress. But the sooner China's own Bear Stearns and Lehman moment happen, the more likely it is that China can clean up if they're dedicated to reform and then continue to grow after 3 years, say at 5% a year. If they fail to do that and try to just sweep the problems under the carpet, then we are much more likely to face a major financial crisis within 2-3 years' time. And then that will be a very different story in terms both of China's ability to continue with these catch-up growth rates and also for the impact to the rest of the world.
Okay, now I certainly agree with you that China needs to take its lumps sooner rather than later for its own good and for the good of the rest of the world. One point I do want to make, though, is when it comes to a Lehman moment. In the case of the US, they tried to eradicate moral hazard by allowing Lehman to fail and then realized that they in fact needed to pump up moral hazard once more because so many other institutions were in danger of failing. Is there a risk that China, if it allowed a Lehman moment, would face the same situation, or can they actually allow enough truly failed institutions to fail?
Well, they have the ability to absorb the losses through an increase in government debt. And this is what this chart shows, that even if we assume a very drastic scenario, that 50% of all corporate and household loans and corporate net corporate loans, excluding cash, are bad, and zero is recovered, which is an extreme case.
Yes.
And the government has to take on this debt explicitly on its balance sheet. On our calculations, overall government debt will go over 100% of GDP in gross terms, obviously minus 40% of FX reserves, that is over 60% in net terms. And yes, that is a huge jump, but still manageable at this point in time. When we look at Japan, again, for example, they managed to sustain much higher levels of gross debt with much slower real GDP growth rates for years and years. So they can still do it, but they don't have another 2 decades to be blowing up bubbles like Japan did. And that is what I tried to show with the second chart that we had.
Okay, Diana, thank you very much indeed. I think the conclusion is that we all should hope that China addresses this issue very swiftly. And perhaps the one note of for some confidence is that a Lehman moment for China really might genuinely draw a line under its credit problem in a way that it didn't in the US.